One of the things we always used to say when we started PayJustNow was, we'd be changing lives. And after Daniel's talk, I think it's challenging lives. Maybe just quick intro into PayJustNow. Launched in 2019, obviously as a buy now, pay later model. We have pretty much stick to the 3 monthly installments from the start. I think the one nuance that we have sort of changed over time is that we've aligned our collections with the consumer's payday. So everyone gets paid differently, and it's really important because collecting from a consumer when they don't have money is obviously a negative experience for them. But it also impacts your collections, and therefore, the collections, the only way you control that is your approval rate. So by collecting when a consumer has money really increases approval rate, and that obviously optimizes the conversion opportunity for retailers. As we stand today, over 3,000 brands partnered with us since 2019. We started halfway through 2019. We're approaching 5,000 physical stores that we're available in. In fact, we're launching another 600 this week. Across many different verticals. So everything from aspirational apparel to we even within some doctors now, grudge purchases like Tiger Wheel and Tire. When we're talking about hitting the pothole, I had the experience of my wife's tires and my tires all going in 1 month, and it was all 4 of them on each car. So this type of facility really allows that grudge purchase or unexpected surprise, allows you to use it there. Obviously, I don't really want to echo the sort of sentiment around the market that Daniel kind of has been speaking to, but our retailers are saying very much the same thing. The impact of severe load shedding, decreased footfall in malls, high inflation rates that's impacting discretionary income. All of that is evident across all our retailers, and all of that is impacting basket sizes and obviously putting tremendous pressure on their top line. Yeah. I think the reality is that buy now, pay later creates an opportunity to overcome that price resistance that consumers have when they're in this kind of psychologically sort of bad place about all the negative press going on. So just where we are today in terms of consumers, we're growing quite nicely, 24% month on month, sitting just over 820,000 customers at the moment, on track to reach 1.5 million by the end of the year. I really kind of wanted to focus this presentation on the customer because I think at the end of the day, as retailers, that's where our biggest concern is. So I thought I would give you a view on what our customer looks like in the buy now, pay later space and how it's moved since last year. Firstly, our customer is female, 31 years old. She uses a debit card, interestingly. 80% of our transactions are on debit card rather than credit card. So a risk-averse customer, shopping 2.1 times every 90 days with us. So quite engaged. There is a shift towards female. The consumer is getting younger, but we can also see the lower income consumer coming in. I think a lot of that is our move into physical stores. In this last year, we I think launched nearly 3,000 physical stores. That's brought in a wider demographic of customers, and obviously we can see that coming through in their predicted income levels. From a segmentation point of view, we obviously we work with the bureaus, so we do also report into the bureaus, ensure there's visibility for all lenders, unlike some of the buy now, pay laters, not necessarily time. And we also take on thin pile customers, so customers with no credit score. And the interesting part here is if you look at the financial affluency segmentation, there's a big rise in limited means individuals. 38% of those individuals are actually thin pile customers with no credit score. And we report into the bureau, allowing them to build a credit score over time. I think, obviously, as we moved in store, that has shifted the dynamics of where the consumer sits. But also, those customers looking for a way to kind of manage their cash flow over time has definitely acquired a lot more in the sort of more distressed side of things. From a banking point of view, it was quite interesting when I looked at the dynamics here. The big shift towards Capitec. I mean, the big banks are all still processing most of the transactions, but there's been a big shift towards Capitec. I think, for me, maybe echoing what Greg said, customers looking for value in their daily lives, looking to cut costs, and there's a shift there, but F&B seems to have fallen away in our data. How is our consumer performing? So, obviously, this is a premium transaction for retailers. Compared to traditional or to credit cards and debit cards. And so it becomes a very thin margin business for us. And what we have to, our only lever to manage this is risk. You can see our performance over time. We generally try to target 2%. December, there's some sort of seasonality in there. But recently we just got our bespoke scorecard in, which is actually performing 20% better than the credit bureau data that we received. And we've also introduced live selfie. So we've got the same selfie technology now, which has obviously brought risk back in line. Obviously, again, as I say, very important from an approval point of view where our risk sits. So if we don't manage our risk correctly, the only option we have is to cut applications. You can see that our approval rate has dropped from 82% to 76%. I still think it's an outstanding number as a retailer, considering that 3 out of 4 customers who walk into your store are going to be approved for a facility, and a facility that they can immediately shop with. Because that whole sign-up application process is done within 2 minutes, and it's all digital, no paperwork. So no kiosk required. You can see there has been a slight decrease in the average facility we've been granting. I think that's nature of the current sort of macro climate. But interestingly, our average basket size has held its own. At the moment, it's actually up to 1,500. So we're seeing the top-end guys actually coming through and using it more often. Utilization has increased. I see our graph is slightly wrong, but utilization of facilities has gone from 52% up to nearly 60%. Just some of the guardrails that we use to ensure that our customer remains, or firstly pays correctly and remains happy. We make sure that customers on their first transaction can only run one transaction regardless of the size and regardless of how big their facility. Facilities are bespoke, but there is a view to slow and grow them. All transactions are a single line of credit. So as soon as you pay your first installment, you don't have access to that single line until you can shop again. And then, as I mentioned, we've got a bespoke scorecard that looks at various different data points to determine whether that customer will actually repay us. So lastly, we are at PayJustNow committed to buy now, pay later and optimizing the checkout and conversions for merchants. We understand that we have a highly engaged audience with incredibly rich data. We get data right the way from the payload through to device data to where you live, what you buy, when you buy. And we're using that opportunity to create a marketing opportunity for merchants to speak to a highly engaged base. It's a captive audience with a high propensity to spend. I think in the last month we had 3.5 million engagements with customers. That customer base of 820,000 actually has a facility to spend a combined facility of 2 billion. And we expect that to double by the end of the year. So I would suggest that if you aren't talking to us, you should be talking to us. We offer you an opportunity to trade in these difficult times. Thanks.